You buy tech stocks when, Fed's tightening or there's concerns about growth because there's secular growth. And then, of course, you buy income stocks when Fed funds is being cut, removed from CDs usually into preferreds and bonds. So we do think that'll continue, particularly as just volatility drops. Even if the stock market doesn't rip back to 7,000, if we just stabilize somewhere around 6,500, then all the fixed income and probably small caps will start rallying again.
I'm your host, Melanie Schaefer. Welcome to Lead Lag Live. Nvidia just delivered another beat with $57 billion in Q3 revenue, up 62% year over year, and $1.30 earnings per share. The company says it's in a virtuous cycle of AI, yet at the same time, we're seeing mounting questions around CapEx saturation, earnings sustainability, and whether mega cap tech remains the only game in town. That makes this a key moment to rethink what happens if capital begins rotating. My guest today is Jay Hatfield, CEO of Infrastructure Capital Advisors, a specialist in income, value, and active small cap strategies in an environment where yield matters as much as growth. Thanks so much for being here today, Jay.
Thanks, Melanie. Great to be on.
So first off, given the strong Nvidia print, what do you see as the broader implications for the mega cap tech complex and the rest of the market?
Well, the most important thing to keep in mind, and this works 4 times a year, is that greed occurs during earnings season and fear after. So we're after the big tech earnings. And now you might say, well, why did we fade? Well, now we're over all the big tech earnings, not just the 5 that reported, or I guess 6 that reported 2 weeks ago. You have Broadcom coming up. But so all the positive catalysts are behind us. And, we have a 7,000 target on the S&P, but targets are not just for buying, but also selling. So other people had similar targets. They faded the market at 69.40. And then all the short sellers come out with their theses about why the world's coming to an end. And there's not going to be any return on AI investment. OpenAI is going to go bankrupt. Cockroaches and credit. We don't believe any of that. In fact, the Nvidia print was super strong. We raised our target on the company to 260, raised our earnings estimates. So zero evidence of a collapse there. But here's the big proviso. And it's important to get all this information out. It's a little bit long, but so the Mag 8 are roughly fairly valued in our models, which is consistent with that 7,000 target. And Tesla, by the way, has tremendous downside, but we won't get into that. But there's areas on the market, particularly Bitcoin. We hate securities that don't have cash flow, earnings and cash flow. They have neither. And we hate even more levered bets on that, like treasury, crypto treasury companies. So, Bitcoin is kind of crashing on a levered basis. And that's taking some air out of the speculation in the tech market. And given that we're past earnings, we're into this technical market. And appropriately, the market rallied, but then we faded at the 50 days. So now we're crashed below that. We think the 100 days support, which is roughly 6,500. So we think we're fine, but there's going to be volatility. I would watch Bitcoin, not because I like it, but definitely having a crash every day and having MicroStrategy, I think, is down, might be down 10%. I'll look that up as we're talking. But until that stops crashing, you're probably going to still see at least a lot of nervousness, if not downside, in the overall tech market, because it does kind of suck capital out of tech investors. So MicroStrategy is down $10 and 6%, kind of in line with Bitcoin. They're levered Bitcoin. So that just kind of puts a little bit of risk into the marketplace. So, we're going to have to just bang around these moving averages and settle down a little bit.
Jay, what about the large cap dividend stocks if a rotation begins away from the momentum names? Why might dividend rich large caps offer a sweet spot, and how are you positioning for that scenario?
So we have a big focus. Well, obviously, preferreds are really, that's all they are. So they're acting the way they should, which is defensive. We have a more defensive portfolio than the index. So we've been significantly outperform as, for instance, the index has a ton of MicroStrategy preferreds. We have zero. And so our funds, when big sell-offs like today, they're going to down a little. You still get your 9% yield. ICAP, we have a lot of defensive dividend stocks there. We write covered calls. That works well when the market's volatile and down. So do you think it's better to be in dividends? It's good to be diversified. And then you have some tech stocks, some large cap dividend funds like ICAP or small cap like SCAP, have some preferreds, have some bonds. And then you get less worked up about, the NASDAQ moving like 4% in a day like it did today.
Yeah, and I want to take a minute now and talk about rate, something we talk about every time that we do these podcasts. Let's dig into that a little bit. And I mean, with the market looking toward a possible cut in December, some think, and more in 2026, you've made a case for small cap value as well via SCAP and income via preferreds, as you just said, and corporate bond funds, the ETF BNDS. Can you walk us through why you favor those plays heading into 2026?
So that's the history that you sell small caps during a Fed tightening cycle and you buy them during a loosening cycle. The only issue is, of course, we have a incompetent Fed following a flawed policy framework. So we're relatively certain, unless there's another employment report that's super negative. Today's was sort of positive, mixed but positive. Then they're definitely not going to cut because they have a lot of Keynesians whose models are broken, but they haven't fixed them yet, or they haven't changed them yet. So almost certainly, if you listen to them, like the Kansas City or Cleveland Fed president seems to be totally out to lunch. So they're not going to cut. But the good news is the new Fed chair is definitely going to cut. So probably small caps are a little bit more of a 26 asset class. I mean, they're getting their bounces. They're bouncing earlier today. But as long as the cuts are expected, we think they will outperform. And not just the norm. You buy tech stocks when, Fed's tightening or there's concerns about growth because there's secular growth. And then, of course, you buy income stocks when Fed funds is being cut, removed from CDs usually into preferreds and bonds. So we do think that'll continue. And particularly as volatility drops, even if stock market doesn't rip back to 7,000, if we just stabilize somewhere around 6,500, then all the fixed income and probably small caps will start rallying again.
What are you predicting for next year in terms of inflation and money supply growth and even tariffs? And how are you incorporating those inputs into your portfolio out?
So we have a non-consensus call on that, budget deficit is going to get way better next year. But we don't just make it up. We have a model and forecast. And it's important to know CBO doesn't include tariffs, or at least hasn't so far, because they just do the change in the law, and the only tariffs aren't in the law. So budget deficit's going to decline to 4.5%. That'll be a tailwind for bonds, not critical, but a tailwind. And we do need Fed cuts down to 275 to get to 375. That's our target on the 10-year. We do think we'll get there with the new Fed chair. So no real change, even though in our forecast, even though this month or really December, next month, very low probability of a cut.
And I just, lastly, I want to pivot a little bit. Energy demand is changing really fast with AI and data centers, electrification infrastructure build out, all pointing to higher natural gas and midstream demand. Why do you believe MLPs such as AMZA are positioned to benefit from this shift?
So pipelines are, even if nobody really gets too excited about them, it's great because they have tailwinds. Not the natural gas prices are going to skyrocket, but the throughput is. At the margin, you have to use natural gas to produce electricity. So all these data centers are going to require more natural gas. That's more throughput. Price will probably remain contained because it's a waste product to drilling for oil. So we're bullish on that. We're tilted in AMZA towards natural gas companies. It's been working well. Hasn't become overvalued like a lot of the AI plays. So there's that upside. But even if that doesn't happen, you get solid dividend growth of about 5% a year, about a 7% yield. So you get low single-digit returns, tax deferred. In the case of AMZA, you get a 1099 versus a K1. So we like the sector. It's more defensive. It's acting more like fixed income. So I wouldn't do it to play the AI boom, but just be aware there's a tailwind. Great way to get tax deferred income.
And Jay, just lastly, for investors, advisors, et cetera, who want to find more about your research, delve into what you're thinking and what you're following, where's the best place for them to go?
They can go to infracapfunds.com. And there you can email us or even call us or text us. Love talking to our clients, 100% available to anybody interested. So definitely recommend that. Great proprietary economic research there too.
Fantastic. Well, Jay, it's always so great having you on, and I always appreciate your insight into the markets. Also, thanks to everyone for watching. Be sure to like, share, and subscribe for more episodes of Lead Like Live.